Jamie Dimon is the CEO of the largest U.S. bank, JP Morgan. In his recent annual letter to shareholders, Jamie Dimon acknowledged a strong U.S. economic performance and sticky inflation. He sounds a lot pessimistic than the market thinks. He said the market is pricing in about a 70 to 80% chance of a soft landing. But Jamie Dimon believes the odds are a lot lower than that. And he also mentioned that in response to potentially stubborn inflation, the interest rate would soar past 8%. To give you a bit of a background, the current Fed funds rate is at 5.25 to 5.5%. So to go to 8%, that means there would be another approximately 3% increase in the Fed funds rate. So Jamie Dimon has expressed his support for Federal Reserve to stay hawkish for longer before. On an event happened March this year, he said if he was the Federal Reserve, he would wait, meaning that the Federal Reserve should not be cutting interest rates so quickly. Jamie Dimon said their credibility is at stake. He said he would even wait past June and let it all sort out. Now, it seems like Jamie Dimon wants the interest rate to go higher for longer, and even mentioned 8%. Why? Why is that? How does he get benefited by that? It is because large banks typically benefit in such a macro economy. Higher interest rate means that the banks can charge more for their loans. It's either for a mortgage or car loan or business finance. So, which boosts the bank's interest income. Banks lend out at higher rates while paying relatively less on the deposits, widening their profit margin. Okay, so when the spread between the two yields gets higher, right, the yield on the deposits the bank pays out and the yield the bank receives on the loans it lends out. When the spread gets widened up, their profit margin increases. So this chart shows you that when the interest rate goes higher, the net interest income of a bank increases as well. So the net interest income is the total revenue earned from interest on loans, securities, and other interest-earning assets, minus the interest paid on deposits and other liabilities. However, as the interest rate climb higher and remain elevated for a while, the situation starts to shift. The cost of attracting and retaining deposits increase as customers seek better returns on their savings. Right? This is because as the high interest rates persists, customers grow more aware of the situation and expect better return on their savings, forcing the banks to raise interest rates that they're offering on their deposits so that they can stay competitive and retain their customers. As an example, right, if the customer is witnessing some money market fund or cash generating ETFs that are giving the investors an annual return of 5%, they would of course question their banks on how much they're getting paid on their savings account. If there's too much of a difference, customers start to take money out of their deposit account or savings account and put it in somewhere else, like money market fund, right? So so when the bank raise their interest rate on deposits to stay competitive, it hurts their margin, right? It hurts the bank's net interest income, as shown in this chart. when the interest rate stays high for a while. So recently, the big banks have released their Q1 earnings. Even though they beat the expectation, but their forecasts are muted because the executives of those banks warned that their core lending income would be muted this year as higher interest rates forced them to pay up the deposits. And this is a chart of the net interest income of the three major banks. JP Morgan in dark blue, red is Citibank, and the light blue is Wells Fargo. As we can see, the net interest income shrank on a quarterly basis for JP Morgan for the first time since year 2021. And for the other two banks, Citigroup and Wells Fargo, they also saw a quarterly decrease in their net interest income. So I think this is the reason why Jamie Dimon is advocating for further rate hikes towards 8%, because if the interest rate increases further, it would potentially lead to a wider spread between what the banks can charge for their loans and what they must pay on deposits. So meaning that it will create another surge in the bank's net interest income before the cost catch up again, right? So this chart shows you if the interest go up to 8%, the right-hand side also increase. Thank you. Don't forget to subscribe.